let's talk about something that trips up a lot of new options traders. And honestly, even some experienced ones who haven't thought carefully about it. The difference between in-the-money options and out-of-the-money options.
Now, I know those phrases sound like Wall Street jargon designed to confuse you, but once you understand what they actually mean, not just the definition, but the why behind them, a huge chunk of options trading starts to make intuitive sense. Pricing, risk, probability, behavior, near expiration. It all clicks. So here's what we're going to cover. We'll define ITM, OTM, and ATM clearly with concrete numbers. We'll talk about intrinsic value and why it's the key to understanding all of this. Then we'll get into why these distinctions matter for real trading decisions. Premium cost, delta, risk reward, probability of profit. And we'll finish with the most common mistakes traders make when they're just starting out.
To make this tangible, we're going to use one simple example throughout. Imagine a stock, let's call it XYZ, currently trading at exactly $100 per share. That $100 price is the anchor. Everything in options is relative to where the stock is right now. And the key question we're always asking is, how does the strike price of the option compare to the current market price of the stock? The strike price, in case you need a quick refresher, is the price at which the option gives you the right to buy or sell shares. That's the number printed on the contract. And whether that strike is above, below, or equal to where the stock is trading right now. That's what determines whether an option is in the money, out of the money, or at the money.
Let's take them one by one. We'll start with at the money, because it's the easiest and it gives us a natural anchor. An option is at the money when the strike price is equal to, or very close to, the current stock price. So if XYZ is at $100 and you're looking at the $100 strike call or the $100 strike put, those are at the money options. ATM options are interesting because they're right on the fence. They have zero intrinsic value. We'll explain that in a moment, but they have a lot of what we call extrinsic value or time value. Market makers price them expecting that the stock could move enough to push them into the money before expiration. Think of at the money as the neutral zone. It could go either way.
Now let's talk about in the money options. This is where the concept of intrinsic value becomes critical. Intrinsic value is the real tangible value an option has right now if you exercised it immediately. It's not about what might happen. It's about what the option is worth today, the second, based on where the stock is trading. Here's the formula. For a call option, intrinsic value equals the current stock price minus the strike price. For a put option, it's the strike price minus the current stock price. And an option is in the money whenever that intrinsic value is greater than zero. Let's make it real. XYZ is at $100. You hold the $90 strike call. That means your option gives you the right to buy XYZ at $90 when the market is selling it for $100. That's a $10 advantage. That $10 is intrinsic value. Your call option is $10 in the money. What about a $95 strike call? Intrinsic value is $5. It's $5 in the money. What about the $100 strike call? Zero intrinsic value. That's at the money. What about the $105 strike call? It gives you the right to buy at $105, but the market price is $100. No one in their right mind would exercise that. There's no intrinsic value. That option is out of the money. Now puts work in the opposite direction because puts give you the right to sell shares. XYZ is at $100. You hold the $110 strike put. That means you can sell XYZ at $110 when the market would only give you $100. That's a $10 advantage. Your put is $10 in the money. The 105 put, $5 in the money. The 100 put, at the money. The 95 put, out of the money. There's no advantage to selling at 95 when the market gives you 100. Key takeaway. ITM options have real actual value baked into the price right now. That's intrinsic value. You're paying for something concrete. Out of the money options are the opposite. They have zero intrinsic value. Every single dollar you pay for an OTM option is what we call extrinsic value, also known as time value. It's purely the market's estimate of the probability that the option might move into the money before expiration. XYZ is at $100.
The 110 strike call gives you the right to buy at 110, but the stock is only at 100. The stock would need to rise $10 just to reach your strike. That option has no intrinsic value. It's $10 out of the money. The 120 call, $20 OTM. The stock needs a 20% move just to reach break-even at expiration. For puts, the $90 put gives you the right to sell at 90, but the market is at 100. You'd only want to exercise that if the stock dropped $10 or more. $10 out of the money. The 80 put, $20. You need a $20 decline just to reach your strike. Here's the thing about OTM options. They're cheap, and cheap feels good. But cheap for a reason is a very different thing from cheap as in a bargain. We'll come back to this. So now we understand the basic definitions. ITM means the option has intrinsic value. It's already in profit on the intrinsic side. OTM means zero intrinsic value. You're entirely betting on future movement. But why does this matter for how you actually trade? Let's get into the practical implications. First, premium cost. ITM options cost more, a lot more. That $90 strike call on a $100 stock, it might cost $12 or $13. $10 of that is intrinsic value. The rest is time value. The 110 call, maybe $3 or $4. All of that is time value. There's no intrinsic value in there at all. The 120 call, maybe 50 cents. Very cheap, because the stock needs to move a lot for this to be worth anything. So when you buy an ITM option, you're paying a higher premium, but a significant chunk of that premium is real. When you buy a deep OTM option, you're paying a smaller number, but it's entirely speculative. Second, delta. Delta is one of the most important Greeks. It tells you how much the option's price changes for every $1 move in the stock. Delta ranges from 0 to 1 for calls and 0 to -1 for puts. Deep ITM calls have deltas close to 1. That means if XYZ goes from 100 to 101, your $80 strike call goes up almost $1 too. It moves nearly dollar for dollar with the stock. A TM options have deltas around 0.5. A $1 stock move translates to roughly 50 cents in option value change. Deep OTM options might have deltas of 0.1, 0.05, or even lower. A $1 stock move barely moves the needle. The 120 call maybe gains 10 cents when the stock rises $1. Delta is a double-edged measure. High delta gives you more upside participation, but also more downside exposure. Low delta means more leverage in percentage terms if you're right, but a very low probability of being right in the first place. Third, probability of profit. Here's the sobering reality about OTM options. That 120 call with XYZ at 100 might have a delta of 0.05. Loosely, delta approximates the probability of the option expiring in the money. So that option has roughly a 5% chance of being worth anything at expiration. The 105 call might have a delta of 0.35, about 35% chance. The 95 call, which is ITM, might have a delta of 0.7, a 70% chance of expiring in the money. Now, probability of profit isn't the whole story. The question is always, does the potential payout justify the odds? That's where risk-reward comes in. ITM options. Higher cost, higher delta, lower leverage. If you buy the $90 call for $12 and the stock goes to 110 at expiration, your option is worth $20. You've made $8 on a $12 investment, about 67% return. OTM options, lower cost, lower delta, but explosive leverage if they work. If you bought the 110 call for $3 and the stock rockets to 120, your option is worth $10. You've tripled your money. A 233% return on the same stock move. But, and this is the critical but, if the stock only goes to 105, the ITM option is still worth $15. You made money. The OTM 110 call, worth nothing. You lose 100%. That's the fundamental trade-off. ITM options give you a higher probability of making something. OTM options give you a higher percentage return if you're right, with a much higher probability of going to zero. Now let's talk about where people go wrong, because understanding ITM versus OTM isn't just about definitions. It's about avoiding the traps that drain accounts. Mistake number 1, buying FAR OTM options as lottery tickets. This is the most common one, especially for traders who just discovered options. The logic goes like this. I only have $500 to invest. If I buy the 130 calls for 30 cents, I can buy 16 contracts and control 1,600 shares. If the stock explodes, I'll make a fortune. And yes, and technically on a moonshot move, that could happen. But what you're really doing is buying 16 tickets in a lottery where the odds of winning are maybe 2 or 3%. Most of the time, those contracts expire worthless. You lose 100%. FAR OTM options are not cheap. They're cheap in absolute dollar terms, but they're almost always overpriced relative to their actual probability of paying off. Market makers are not in the business of giving free lottery tickets. Mistake number 2, ignoring time decay on OTM options. Even if you're directionally right, even if the stock moves in your favor. OTM options can still lose money because of time decay, also called theta. Every day, the time value in an OTM option bleeds away. An option that cost you $2 today, if the stock just sits there for 2 weeks, might be worth $150. Nothing happened. You didn't make a mistake. Time just eroded the value. For OTM options especially, you need to be right about direction and timing. Being right about direction, but a week late, can still mean losing most of your premium.
Mistake number 3, confusing cheap with good value. A 40-cent option feels very different from a $10 option. But in options trading, the price alone tells you almost nothing. Value is about whether the option is fairly priced relative to its probability of being profitable. A deep ITM option might look expensive at $12, but if it has $10 of intrinsic value, you're only paying $2 for time value. That can be excellent value. A 40-cent FAR OTM option with a 1% chance of expiring ITM, that might be expensive for what you're getting. Mistake number 4, not understanding your break-even at expiration. For a call option, your break-even at expiration is strike price plus premium paid. For a put, it's strike price minus premium paid. If you buy the $100 call for $5, you need the stock to be above 105 at expiration just to break even. The stock can go up. You can be right about direction, and you still lose money if it doesn't move enough. This is especially dangerous with OTM options. That 110 call you bought for $3, the stock needs to hit 113 just for you to get your money back. Know your break-even before you enter a trade. All right, let's bring it all together. There's no universally better choice between ITM and OTM. It depends entirely on what you're trying to accomplish. ITM options make more sense when you have high conviction the stock is moving in your direction and you want reliable participation. When you're using options as a stock substitute, capturing most of the upside with less capital than buying shares outright. Or when you're selling covered calls or cash-secured puts and want to collect higher premium. OTM options make more sense when you're making a defined risk speculative bet and want to limit dollar exposure. When you genuinely expect a large move, a catalyst, earnings surprise, or breakout that would make the high leverage worthwhile. Or when you're hedging a portfolio and want protection against a significant downside move without spending too much. The key is going in with your eyes open. Know your probability of profit, know your break-even, know how much time decay is working against you, know what the stock needs to do for your trade to work. Let's lock this in with something you won't forget. In the money is already there. Out of the money still needs to get there. When you buy an ITM option, you're paying for real, existing value, plus a little extra for the time remaining. The hard work of moving in the right direction has already partially happened. You have intrinsic value on your side. When you buy an OTM option, you're buying pure potential. No intrinsic value. Just a bet that the stock moves enough, fast enough, before expiration. These options are cheaper, but they expire worthless far more often. The relationship between moneyness and delta tells you your odds. A delta of 0.7 means roughly 70% chance of expiring ITM. A delta of 0.1 means roughly 10%. You're trading off cost against probability every single time. Intrinsic value is the anchor. Extrinsic value is the bet. ITM options are heavy with the former. OTM options are pure versions of the latter. And when someone shows you a 25-cent option that could turn into $5 if the stock goes up 40% in 3 weeks, smile, nod, and remember, that's not a deal. That's a lottery ticket. Sometimes lottery tickets win. But buying them repeatedly is not a strategy. It's a donation. Know your strike, know your break-even, know your delta, and know whether you're paying for intrinsic value or just hope. That's ITM versus OTM. And now you know it cold.